All right, everything should be good to go. All right. Like my man Matthew McConaughey says, but we're finally live. Sorry it took a quick minute to get everything set up, but the mic is working. So originally was working. For some reason, I didn't think it was working. But we're good to go. And for all those people on my IG, go ahead, head over to YouTube. Trying to funnel everything through YouTube now. So I posted the link in my story, new story. Head over to YouTube. We're live. We're live on Instagram and on YouTube, but this will only be recorded on YouTube. So I will not be recording and archiving anything on Instagram anymore. All right, let's gonna hop into it then. So today I want to talk about Roth IRAs, and in some of my previous streams, men's value tips, some other content, I've mentioned Roth IRAs, the basics of it. Today I want to go a little bit more in depth on what Roth IRAs are, how you can use them, maybe some allocation strategies you can use. What's the difference between Roth IRA? Everyone's heard of a 401k. You get a job, full-time job. They typically offer you some sort of 401k where you can save for your retirement, you can invest for your retirement. And then there's a traditional IRA. So what are the differences between these three different accounts? Is there one better than the other? How can I use this in the situation, stage in life that I'm currently in right now? Hopefully I can answer all of those questions. And I have done a good bit of research. I was very familiar with a Roth IRA to start off with. I've been using it for many years. So it was great to kind of dive deeper into it, what a Roth IRA is, who is eligible for one, who isn't eligible. There's this thing called a backdoor Roth IRA, which I knew about, didn't really know how to do it, but now kind of digging in, did some research, I understand how it works now. So I'm going to cover all of that stuff. First, I want to talk about what an IRA is, or a Roth IRA. I mean, everyone knows what investment accounts are. They're accounts you put money in. You can purchase whatever kind of asset that you want. Hold on, I'm going to move my Instagram folks over here. Okay, that's a little bit better, so I can talk a little bit more into the mic. But investment account, so you typically add some sort of cash to an account if you've never had an account before, and you can open up these accounts at pretty much anywhere, at any investment firm, bank typically as well. So the big ones: Vanguard, Fidelity, Charles Schwab. For my work, we work with a lot of different brokerages: SEI, National Financial Services, Pershing, TD Ameritrade. I could name hundreds. There's a lot, and there are some that are bigger than others and some that are smaller. So there's pros and cons to those, but that's not kind of the basis of what today's live is going to be about. I'm going to focus on what Roth IRAs are, not necessarily the different brokerages that are out there, because there's, like I said, hundreds. But you can pretty much open up a Roth IRA anywhere. So it's super easy. You can literally type in Roth IRA account, and then there's going to be a million sites that pop up where you can open one up. So a traditional investment account, just a typical brokerage account, is different. You just contribute whatever cash you have, and you can invest in stocks. You can invest it in different ETFs, exchange traded funds. You can invest in mutual funds, index funds. There's a lot of different investment vehicles, and if you don't know what I'm talking about, check out my live stream where I talked about the 25 different investment vehicles. I kind of do a little bit of breakdown of what all those things are. So today we're going to focus on Roth IRA. So a Roth IRA, of course, you kind of think of the definition of it. So I've used a couple of different sources, one coming straight from the IRS website, and I know people say Investopedia, it's not a great source. What's up, Abe Israti, my guy? Yes, I am repping the Uniqlo. Actually, this is not Uniqlo, this is GU. So it's the sweatsuit. For all my Japanese people out there, you know what it is. They're coming in style here in the States, which is awesome. They've been around for a long time in Japan and internationally as well. So yes, it's GU. Anyway, kind of going back to what a Roth IRA is, it is it's an account where you can contribute post-tax dollars in, and it's a retirement account. So it stands for, or IRA stands for, I have it written down right here. I always thought it was investment retirement account or whatever. So it actually stands for, I have a ton of notes. I have no idea where it went in my notes. Individual retirement account. So I always thought it meant investment retirement account, but it stands for individual retirement account. So it's where you contribute post-tax dollars. So if you think of it, I guess the easiest way to describe it is, actually I won't do that because I'm going to touch the difference between 401k, traditional IRA, and Roth IRA. So think of just money you make from your job or whatever. You have some cash lying around. You can contribute that to a Roth IRA. So that's, I'll kind of go into what post-tax dollars and pre-tax dollars are and why that makes a difference and how that affects taxes. And it does. So you contribute whatever cash you have from your job or side hustle. You sold some pair of Nikes or whatever. I sold some shoes, so I have $500. I'm gonna throw into open up a Roth IRA. I'm gonna throw some cash into it. So you contribute this money, and like it stands for IRA, individual retirement account. It's for your retirement. So traditionally, how these types of accounts work are you put money into it. You can invest whatever into it. Typically, stocks, bonds, ETFs, mutual funds, index funds. REITs. You can, for some brokerages, it just depends on the brokerage. You can invest in some alternative assets. You can real estate, different types of funds, private equity, a lot of different ways you can invest it depending on the brokerage that you're using. But you can invest in whatever you want, and obviously the goal is to receive dividends, to invest in stuff that's going to over time appreciate in value, and when you retire it's going to be a considerable amount. You can use compound interest, reinvest everything, and you have a good chunk of change, a good nest egg when you retire. The cool thing about it is, traditionally, I mean, think of any investment account. You invest in something, it appreciates, you sell it, buy low, sell high, but you're typically taxed on the gain. It's what we call capital gains. The gains that you realized during when you sold the asset. So the amount of increase from when you bought it to when you sold it. So say I bought a stock. Let's just say I bought Amazon or Nvidia, since Nvidia is super hot topic right now. I bought Nvidia when it was $20 a share, super steal. I got in really early, and I sold it what it's at right now, which I believe it's something crazy. Yeah, it's at like almost $400. So $389. Let's just call it even 400. Bought it for $20, sold it for 400. And let's just, for this case, let's just say I had 10 shares. So originally my cost basis, what it cost me total for 10 shares of Nvidia stock at $20 each, $200. And I sold it at $400 a share. So 400 times 10, that's 4,000. So 200 minus 4,000 minus 200 is I profited $3,800, $3,800. So that's pretty good investment. Yeah, it's a really good investment. So, but what we call that 3,800 in profit that I got, that's capital gains. That's what we call capital gains. The amount that you made as the asset appreciated in value over time from the original cost that you bought it at. So typically how it works is when you sell that, you're taxed on it. And depending on how long you held it, there's typically a long-term capital gains rate that you'll get taxed, or if you've held it under a year, then you get taxed short-term capital gains, which is just typically your normal income tax. But the long-term capital gains tax is around like 20%. So if you're in a high tax bracket, it's worth your while to hold these stocks and these assets for longer than a year. Because if you don't, you're already in a super high tax bracket, which, I mean, taxes, I might even have a whole thing on itself. I am not an accountant. I'm not a CPA. I'm no expert, but I would say I know more than the average person. Anyway, but you want to hold it longer than a year, so you get that 20% instead of, say, like 40 or 50% if you're making a ton of money in your 30s, 40s, 50s, 60s. So anyway, that's capital gains. And the cool thing with a Roth IRA is with this specific type of account, it's a tax advantage account where you don't have to pay anything capital gains wise. You actually, once you turn 59 and a half, you're eligible to start withdrawing money from the account tax-free. So whatever your stocks or your assets appreciated to, you sell them, you pull it out, you don't have to pay capital gains on it. So if you make that, so it's a really great account where if you buy low, sell high, especially traditionally the market, it'll go up 7-8%. This is the S&P per year on average. So think about compound interest and 50, 60 years. Say you started investing when you were 20 and you have this Roth IRA account and you retire, you're like 59 and a half, the minimum age, or say you're 60, 65 when typically most people retire. You have a good chunk of change. And with 7% compounded annually, you can turn a small amount of money into a considerable amount of money. And you can pull it out tax-free. So that's the whole point and why Roth IRAs are so awesome. The thing is they do come with rules and they come with caveats. So, and for people who are on Instagram, check out my most recent Instagram story. Head over to YouTube. I'm live on YouTube, funneling, trying to have everything go through YouTube now. And that's where it will be recorded and archived. Anyway, so kind of the rules behind it is Roth IRA, typically if you invest or contribute to some sort of retirement account, you get some sort of tax deduction. And that's for traditional IRA accounts and 401ks. But this is not the case for Roth IRA because you're doing post-tax dollars. And I can get into that when I compare the three different types of accounts. But after 59 and a half, you can pull out distributions. They're all tax-free. You can make contributions to your Roth IRA after you reach 70 and a half. You can leave amounts in your Roth IRA as long as you live. This is coming straight from the IRS website. I'm going to put everything in the link to the description so you can check it out, kind of where I'm getting my information from. And some of the rules I'll actually read from the website. So there's people who are eligible for a Roth IRA and there's people that aren't eligible for a Roth IRA. And this typically is determined by how much you're making. And if you file your taxes as a single person like myself, the limits are going to be different from if you file married. If you are married and you file your taxes jointly as a couple, it's going to be a little bit higher. So this is why I am an advocate for anyone that's young. Honestly, if you're 18 and above, you should have a Roth IRA. I really wish I started when I was 18, just throwing some money every single year, even though I didn't make enough money to contribute the full amount that I could. I started it when I was 21, and I've been doing the max every single year. It's not a crazy amount, and I'll get into that, but kind of how much you can make before you're ineligible to have this account and contribute to this account. If you're married and filed jointly, then your income has to be less than $218,000 to contribute the max. And the max you can contribute per year, this is as 2023, this does change from year to year, is for people under 50, you can contribute up to $6,500, so $6,500 every single year for each calendar year, tax year. If you're 50 or older, you can contribute an additional $1,000, so for a total of $7,500 every single year into this account. So it's very much worth everyone's while to contribute the max you can. So for people that are under 50, it's $6,500. For people that are over 50, you can contribute $7,500 to it. And kind of the limits, if you make over $228,000, you can't contribute at all. If you're, and this is for married people, married filing jointly, if you make between $218,000 and $228,000, so you're in between kind of the threshold, you can contribute to a Roth IRA. It's just at a reduced amount. Now for my single people out there, so for single people, if you earn more than $150,000 in 2023, then you cannot contribute to a Roth IRA. For those that make less than that, less than $138,000, then you can contribute the full $6,500. If you make between $138,000 and $153,000 in 2023, you can contribute. It's just at a reduced amount. And like I said, if you make over $153,000, you can't contribute anything. But there's this thing called a backdoor strategy, a backdoor Roth IRA, that you can actually contribute to an IRA even if you're making more than $153,000. And I'll cover that a little bit later. But those are kind of the limits. So if you're married, kind of to keep it simple, if you make jointly as a couple less than $228,000, you can contribute the full amount. $6,500 if you're under 50. $7,500 if you're over 50. For people that are single, not married, you can contribute to the full amount, $6,500 or $7,500 if you're over 50, if you make under $153,000. And because this is post-tax dollars, these are not deductible. A couple things as well. Like I said, depending on the brokerage that you have, determines what assets you can contribute to it. You cannot at this time directly contribute cryptocurrencies, unfortunately. But there are IRA accounts that are starting to be made that you can invest into crypto. I know there's kind of indirect ways that you can invest in crypto in a Roth IRA, but as of right now, you can't directly, say, send Bitcoin to your Roth IRA account. And other things you can invest, life insurance contracts, derivatives, kind of your untraditional assets. And those are the contribution rules. As far as rules for taking money out, like I said, you can take money out tax-free, no penalty, if you're 59 and a half or older. There are some exceptions. There are a ton of different exceptions depending on kind of what the reason is. The main exceptions is say you contribute in 1 year $6,500, the max amount you can as a single person or as someone under 50. You can basically pull out what you contribute without any penalty. So say beginning of this year I contributed the full $6,500, and something along the line comes out. I have a huge expense. I kind of exhausted all my savings, don't really have extra cash, strapped for cash. I have stuff in my Roth IRA account, contribute that $6,500. I can pull an amount up to $6,500. I can pull $2,000 out. I can pull the full $6,500 out without any penalty. So you can pull out what you contribute. And that's about it. If you pull out more than you contribute, then there's a penalty. So let's say 5 years go down the line, I contribute every single year, and let's just say I've contributed in 5 years' time $10,000 worth. Let's just say $20,000 worth. I'm strapped for cash again. I have to pull it out, and during that 5 years, stock market has gone really well. I've turned that $20,000 I originally contributed, and it did really well. Let's just say it turned into $40,000, so it doubled. I can only pull out $20,000, but if I'm really strapped for cash, I owe some people some money. I had some bad gambling debts. I bet too much on the Mavs. Then I actually owe 40 grand, or let's just say for this case 30 grand. You can pull that money out. There's just going to be a penalty. You're going to have to pay taxes on the capital gains, so that 10,000 of capital gains, and or a 10% penalty. I think it's probably whatever the lower of the two, I would assume are. Not exactly sure on that, but so you either pay the taxes on the capital gains of your earnings, more than you contributed, or you pay a 10% penalty. So that's kind of the caveat. The exceptions to this rule are you can pull out. Say you want to buy a house, your first time homeowner. You can pull out more than what you contribute for a purchase of your first home, up to $10,000. So that is one exception, and there are a few other exceptions, but they're kind of, what do you say, uncommon, rare exceptions. So, sorry, what's up, my guy James? He had a question on IG. He said, is the minimum $50 a month worth it instead of loading 200 plus for better rates? James, I don't know exactly what you're talking about. So if you give me some more clarification, are you talking about a Roth IRA or, I'm not exactly sure exactly what you're talking about. But you can kind of like a Roth IRA, okay. So there's actually no minimum per month. You can contribute a total for you, because you're under 50, $6,500 for the entire year. So if you want to split that up into monthly payments, you can. If you want, typically what I do is at the beginning of the year, I'll just throw $6,500 into that account. As far as for better rates, I mean, I'm all about, there's some people that are like, all right, I'll contribute X amount of dollars per month to kind of capture whatever gains in the market or whatever. People typically try to time the market, which you can. It's super hard to do. If you find a way, tell me, because people that say they can time the market, typically they can't. But, so I say, my guy Adam Sosnick, he says this as well, but time in market over time, meaning the market. So I typically throw it in at the beginning of the year, depending on how much cash I have, or as soon as I have that amount of cash, I'll throw it into a Roth IRA. That way I can realize gains that I might miss from trying to time the market. So my recommendation would be do the full amount. If you can't do the full amount, then contribute a little bit at a time. If you got to do it monthly, but I typically like to do a lump sum. So I hope that answers your question. All right, so I went over kind of the rules for a Roth IRA. There's a couple different ways that you can contribute to a Roth IRA. Regular contributions, you're just putting money into it, cash into it, this account. There's these things called spousal IRA contributions. So one way a couple can boost their contributions is they can fund their Roth IRA on behalf of the married partner who earns little to no income. So, yeah, say you have, let's just say in this case, it's like you're the husband and you make most of the money. You can actually make an IRA for your spouse, and you can contribute into your wife's Roth IRA that you make for her. if she doesn't really make much money. Transfers, so you can just transfer from one Roth IRA to another. It's more of like a transfer of brokerages. Rollover contributions, so you can roll over a Roth IRA. It's kind of, I would say, somewhat similar to a transfer. You can roll it over into another Roth IRA. And then there's these things called conversions. So you can actually convert different kinds of IRAs, a traditional IRA into a Roth IRA. There's these things called SEP IRAs. So if you're self-employed, or simplified employee pension. I actually thought it stood for self-employed. But anyway, you can do a SEP IRA and convert it into a Roth IRA. And you can actually take a 401k. So say you're working for a certain company, you change jobs, you get a new 401k. So you can actually roll over that old 401k from your old job into a new Roth or into a Roth IRA. And when I talk about the backdoor strategy, that's exactly what it is. It's just converting a 401k or a traditional IRA into a Roth IRA. The only caveat with that, and I'll explain it more in detail when I get there, but you'll have to pay the taxes on whatever you contributed, because those were contributed with pre-tax dollars, not post-tax dollars. All right, and so those are some of the contribution sources that you can use to fund your Roth IRA. All right. Now I'm getting to the differences between Roth IRA, 401k, traditional IRA. So those are kind of the big three that we talk about. Big three, it's not Chris Bosh, it's not LeBron James, it's not Dwayne Wade. Actually the big three stands for Roth IRA, 401k, traditional IRA, if you didn't know already. But I'm sure everyone's heard of a 401k, briefly mentioned it a second ago. But a 401k is typically you join a company full time. It's an account that they set up typically with you, or you have the option to, and you can help save for retirement. The thing, basically a 401k and a traditional IRA are the exact same thing. 401ks is with an employer, so with whoever you have your job with, and the traditional IRA is just you doing it by yourself. That's the difference between it. And actually there's two differences. The second difference is the 401k, because it's with your employer, they typically contribute, or they can match whatever you contribute into that 401k. So let's just say there's a 3% match or a 5% match for a certain percentage of your income that you earn. So 401k employer can match, basically give you free money into a 401k. Traditional IRA, because it's not with an employer, just you doing it by yourself, there's no match or anything with a traditional IRA. So those are kind of the difference between those two, but they're very similar. Kind of going into, so when I'll talk about traditional IRA, when you think of traditional IRA, just think of a 401k. 401k, you have the employer match, but other than that, they're pretty much the same. It's a great way to save for retirement, gives you tax advantages. Contributions that you make to a traditional IRA may be fully or partially deductible depending on your filing status and income. And generally, the amounts in your traditional IRA are not taxed until you retire or until you withdraw the funds from your account. So this is the difference between a traditional IRA and 401k and a Roth IRA. So like I said, Roth IRA, it's really cool because you can put money in and you can have your investments grow. And then when you retire, you're older than 59 and a half, you can pull those out tax-free. So whatever you profited off of your investments, you don't have to pay taxes on. The difference, that's a Roth IRA. So what's different about a traditional IRA is you actually, in a 401k, you put in pre-tax dollars. So in this case, with your employer, typically you earn a paycheck. There's a gross amount with that paycheck. It's pre-taxes and everything. And then when you actually receive your paycheck, it's kind of like your net wages. So your employer would typically automatically pay your taxes for you. So that's how it works. But if you have a 401k, they'll actually take money before they pull any money for taxes or send it to the government or anything, and they'll put that money into your 401k account to invest. So that's what it means by pre-tax dollars. So before taxes are taken out of your paycheck, and then you receive your paycheck post taxes, they'll take whatever amount that you allocate to your 401k and they'll put it into your 401k. And then let's just say you contributed arbitrary $200 to your, say every single paycheck you make, let's just say $6,000. Doing pretty well. You're making $6,000 every 2 weeks. So let's just say that's gross. So that's part of your salary. So $6,000, if you contribute to your 401k, then let's just say you contribute $500 at each paycheck. So 6,000 minus 500, 5,500. 500 of that 6,000 will go straight to your 401k. So when they calculate the taxes for your income, they'll actually calculate taxes. Excuse me. Let me take a drink real quick. They'll calculate your taxes instead of on that full $6,000 amount, which they typically do if you didn't contribute to a 401k. They'll actually calculate it on 5,500. So whatever is left from after your contribution to your 401k. So that actually means less taxes up front for you. So it's a really good strategy, and a lot of people like to use it because you ultimately pay less taxes up front. So that's what it means by pre-tax dollars. So you make a contribution before you're taxed on it, and that's for 401k. So in the case of a traditional IRA, you can do this. It's not through an employer, so you don't have to worry about them pulling the taxes and stuff. It's like, say you just work for your own business, or you do some side, even side hustles are post-tax, but let's just say you have your own business and you take some of those pre-tax dollars and then you put it into a traditional IRA. So before you calculate taxes and pay taxes on whatever you're earning, you contribute it to a traditional IRA. So that's what it means by pre-tax dollars. So post-tax dollars is what a Roth IRA is, and it's basically the wages that you receive from your paycheck. That's minus the taxes, because you pay the taxes up front. The employer takes the taxes out of your paycheck, and then you put that money and contribute it to a Roth IRA. So that's the difference between pre-tax, 401k, traditional IRA, post-tax, Roth IRA. So with a traditional IRA, like I said, use pre-tax funds to contribute to it. The catch is, so you save taxes up front by doing that. But the catch is whenever you retire, or whenever you're 59 and a half and you're able to pull that money, you can distribute that money to yourself, then you're actually taxed on it then. So whatever your tax bracket is, that's why people like to, when they retire, so when they retire, they're not really earning much of an income, so they're typically at the lowest tax bracket. So they'll pull their money out then because they're taxed the lowest. If you pull out money when you're making a lot of money, then you're going to get taxed even more. So that's the catch. You save money on taxes up front, but later on you're going to have to pay the taxes when you withdraw from it. So that's the difference between a traditional IRA, 401k, and a Roth IRA. Roth IRA, less restrictive than other accounts. You can maintain the IRA, Roth IRA, indefinitely. There's no required minimum distributions during the lifetime. So that's actually the thing with 401ks and traditional IRAs as well. Typically after a certain age, 59 and a half or whatever, you have to assume some of that nest egg that you have in that account. So it's what they call required minimum distributions. So you have to kind of pay yourself, and then as you pay yourself over a certain amount of time, you pay taxes on that. So that's typically how it works. Roth IRA, you don't have to do that. You can pull it out whenever. So those are the main differences between those. So hopefully everyone understands. If not, leave a comment, throw it in the chat, or leave a comment on the live after it's posted. All right, let's see. Nothing on the chat. All right, we're good to go. We're good to keep going. Don't worry, we're almost done. I know there's for some people this might be super boring. For me, it's super exciting. I love this kind of stuff. Anything to do with money and how to save money, make more money. I'm all about it. And hopefully I can help y'all as well. At least understand the basics. All right, so kind of so far, let's sum up. We talked about what a Roth IRA is, like how to contribute to it, what are the rules surrounding it, what are the difference between a Roth IRA, 401k, traditional IRA, the pros and cons to it of each of those accounts. Now, there's this thing called a backdoor Roth IRA. So for my folks, my guys who are doing super well, and you're making over, if you're single, 153 grand, or if you're married, you're making over 228 grand a year. You might be like, oh, well, I'm out of luck. I'm just making too much money. I can't contribute to a Roth IRA. You actually can. It's kind of a little wraparound. And don't worry, it's not tax evasion. It's not anything like that. It's, like I mentioned earlier, it's basically you contribute the pre-tax dollars into a traditional IRA, and then you just convert that into a Roth IRA. So you may not be able to open a straight up Roth IRA account, but you can open up a traditional IRA account, contribute to the traditional IRA account, and then when you convert it, that's when you actually pay taxes on it. Therefore, kind of, it's like a workaround because it's the exact same way for a Roth IRA. Roth IRA, you use post-tax dollars. So same thing, essentially. But that's a workaround of if you're making longer than that. And you might think, well, it's like, well, if I'm contributing it and I'm still having to pay taxes up front for it, then like what's the point of it? The point of it is like setting up this backdoor Roth IRA instead of just keeping your traditional IRA. You're like, well, I don't want to pay the taxes up front. Well, if you're depending on the tax bracket you're in, well, you must be in a pretty decent tax bracket if you're making over 153 or 228 a year. The benefit is it's basically you're sacrificing upfront taxes for long-term gains. So say you're making a ton of money, but you're like, okay, I have to pay my taxes upfront if I can do this backdoor Roth IRA strategy. But the upside to it is I can invest all this stuff and it'll grow tax-free. And then once I reach the age 59 and a half or when I retire, I can pull this money out. Everything that is appreciated, all that capital gains, I don't have to pay any taxes on. So when I take it out, I don't have to pay any taxes on it. So that might be an idea for people who plan on making a lot of money as well when they're older. So you might be at a lower tax bracket right now, so you pay the taxes up front, put it in a traditional IRA, convert it, you put it in a traditional IRA, you convert it to a Roth IRA, you then pay the taxes on it, on what you contributed, and then you can reap the benefits of no capital gains tax, no additional taxes once you're old enough and once you withdraw those funds from that new Roth IRA account. The catch with this is once you convert it and you're making more than the minimum amount, so if you're making more than 153 if you're single or more than 228 if you're married, then you can't contribute to the Roth IRA. In order to kind of do the same thing, you'd have to contribute it again to a traditional IRA and then convert it again to a Roth IRA. So that's kind of how it works. All right, last thing I want to kind of cover is kind of different allocation strategies. So I've talked a lot about, all right, if you're on this certain tax bracket, then it would be wise to do this, or if you're making a ton of money, then you should put more into your traditional IRA or 401k instead of your Roth IRA because you can't contribute to a Roth IRA because you're making too much money. It get really confusing, so this is it kind of broken down. So I broke it down super simple. If you're in a low tax bracket, so if you're a student, if you're not making a ton of money, you're kind of at the lower end of the tax bracket. If you're not familiar with the U.S. tax bracket, it's a marginal tax bracket. So the less money you make, the lower amount you have to pay in tax. The more money you make, the more you have to pay in tax, percentage-wise. So if you're in a low tax bracket, you kind of in your early years, you're making either no money, not much money, a little bit of money, not a ton of money, then the strategy I would recommend, that's kind of what I'm using right now, is contribute the max to your Roth IRA because you qualify. You're probably not making over 153 or 228 a year. So you contribute the max to the Roth IRA, and then if you have a full-time job after you graduate, then I would contribute up to the employer match to your 401k, and then you can kind of decide after that if you want to contribute more to your 401k or more to a traditional IRA. You can talk to your tax accountant if it would be beneficial, but at least do that. And depending on your circumstance, it may differ. And I'm not an accountant, I'm not a CPA, so this is not tax advice. I'll have a disclaimer at the very end of this. But so that's kind of what I would do, strategies for a low tax bracket. For a high tax bracket, a little bit different. So I would, of course, contribute, if you're still employed by someone, you have a 401k, contribute up to the employer match for 401k, and then contribute as much as comfortable or as much you talk with your accountant as works favorably for you tax-wise to a traditional IRA or to that 401k. And then what you could do as well is you can contribute money into a traditional IRA and then do the backdoor method and convert it to a Roth IRA. So if you plan on even making more money as you get older, even into your 50s, 60s, 70s, then that backdoor Roth IRA would probably be a good option. So very simple, low tax bracket, that's what you do. High tax bracket, that's what you do. In the middle, as long as you're eligible to contribute straight up to the Roth IRA account, say contribute the max every single year, just because you'll save so much in taxes. Like I didn't do any examples. Maybe I can do a separate video itself to show like how much you could save in taxes by doing the strategy. But it's a really good strategy, and the goal is obviously for your investments to do well and make a lot of money doing that. So you could appreciate your assets and you can realize those assets without having to pay any taxes after that. And like, heck, why wouldn't you? I think there was one example. I believe it was, I can't remember if it was Michael Burry or I'm gonna see if I can. Oh, Peter Thiel. So if you're familiar with Peter Thiel, he's a legendary investor. Actually, I think I have one of his books up here. No, I don't. It's not Peter Thiel. It's Peter Lynch, but he's a great guy too. So there's this article. It's crazy because it was big news a couple years ago. So just like all of us when we were younger, Peter Thiel, he was not a multi-billionaire. It's hard to imagine. Some people that are billionaires, they weren't billionaires at one point in life. But it was crazy. He contributed the max, or I'm not sure if he did a backdoor Roth strategy or not, but the headlines say he turned $2,000 into a Roth. So actually, he didn't do a backdoor. This is probably just him contributing when he was young. He wasn't making a ton of money. He turned $2,000 into $5 billion. That is insane. $2,000 to $5 billion. Like what's the math on that? That is insane. So it's like I don't know if I'm doing my math correctly, but it's like 2.5 million increase or percentage increase. That's insane. Turning $2,000 into $5 billion. Oh my goodness. Yeah, it says his account jumped more than $3 billion in just 3 years. And even though he wasn't contributing to it, it says he hasn't contributed anything to his Roth since the year 1999. That was insane. I think it's because he invested into some company, super early stage. I want to say it was like PayPal or something. Let's see if I can see this. Yeah, it was PayPal. So at that time, he bought 1.7 million shares of PayPal in 1999 for $0.001. So a tenth of a cent per share. So he bought basically 1.7 million shares of PayPal for a total of $1,700, so $1,700. And of course, everyone know what happened to PayPal. It's kind of how Elon Musk got super rich. But yeah, it turned to work out really well. And the amazing thing for that is, I don't know how old Peter Thiel is. I don't think he's 59 and a half, but whenever he reaches that age, he can pull all of that money tax-free. Just think about if it was just in a normal investment brokerage account, he would have to pay taxes on that. So let's do the math real quick. I'm curious. So $5 billion times, let's just say, I don't even know what the highest tax bracket is. He's probably in the highest tax bracket. 2023. Highest tax bracket is, I believe, 37%. Yeah, 37%. And of course, there's like other taxes, like state taxes, and luckily I'm moving to Texas. There's no state tax there. So there's even more taxes, just not just the federal tax. But all right, so it's 37%, 5 billion times 37.37. So out of that 5 billion, if you were to withdraw it, you would have to pay $1.85 billion. That's insane. So $1,850,000,000 in taxes, and that's just the federal tax. Like, I'm sure there's even more state taxes and whatever you'd have to pay. Well, actually, in that case, you probably wouldn't, because it's an investment. It's not earnings, wages. But that's insane. Like, he saved $1.85 billion, and yeah, that's insane. So if he had to pay taxes, yeah, he would only have a fraction. He would only have 63% of the original $5 billion. But since it's in a Roth IRA, gets to keep all of it. So obviously, it's probably not going to happen to you. It's probably not going to happen to me. But that's the beauties of a Roth IRA. So I'll wrap it up with there. Just remember Peter Thiel. $1,700, $2,000 to $5 billion. Could be you. So I'm out. As with everything, try to help you guys get stronger, smarter, healthier, wealthier. So follow for more tips, follow for more streams. I'll catch you later. Enjoy your weekend. Memorial Day. I actually might do a Memorial Day stream. I'm not exactly sure yet, but I think I might do a stream on potentially morning routine. I know that was one of the topics I wanted to cover. But hope everyone enjoyed. If anyone has any questions, put in the description. Shoot me a DM on Instagram, and I'll catch y'all later. Peace.